Hello everyone, my name is Purva Jizabra Pawar. I pursue MBA from Science Institute of Management. Today we are going to know about Introduction to Derivatives. What is derivatives? Derivatives are financial contract whose value is linked to the value of an underlying asset. They are complex financial instruments that are used for various purposes, including speculation, hedging, and getting access to additional assets or markets. Types of derivatives. Derivative contracts can broken down into the following four types. First is the options. Options are financial derivative contracts that gives the buyer the right but not the obligation to buy or sell an underlying asset at a specific price, referred to as the strike price, during a specific period of time. American options can be exercised at any time before the expiry of its option period. On the other hand, European options can only the exercise on its expiration date. Second is a future. Futures contracts are standardized contracts that allow the holder of the contract to buy or sell the respective underlying asset at an agreed price on a specific date. The parties involved in a future contract not only possess the right but also are under the obligation to carry out the contract as agreed. Future contracts are traded on the exchange market and as such they tend to be highly liquid, intermediate and regulated by the exchange. Because of the highly standardized nature of future contract, it is easily to buyer and seller to unwind or close out their exposure before the expiration of the contract. Third is the forwards. Forwards contracts are similar to future contracts in the sense that the holders of the contract possesses not only the right but it also under the obligation to carry out the contract as agreed. However, forward contracts are over the counter products, which means they are not regulated and are not bound by specific trading rules and regulations. Since such contracts are unstandardized, they are customizable to suit the requirements of both parties involved. Given the bespoke nature of forward contracts, they tend to be generally held until the expiry and delivered into rather than be unwound. 4 is the swaps. Swaps are derivative contracts that involves two holders or parties to the contract to exchange financial obligation. Interest rate swaps are the most common swap contract entered into the investor. Swaps are not traded on an exchange market. They are traded over the counter because of need of swaps contract to be customizable to suit the needs and requirements of both parties involved. As the market's needs have developed, more types of swaps have appeared, such as the credit default swaps, inflation swaps, and total return swaps. The derivative market. Most derivatives are traded over the counter on a bilateral basis between two counterparties, such as a banks, asset manager, corporation, and governments. These professional traders have a signed document in a place with the one another to ensure that everyone is in agreement on standard terms and conditions. However, some of the contracts, including option and futures, are traded on a specialized exchanges. The biggest derivative exchanges include the CME Group, Chicago Mercantile Exchange, and Chicago Board of Trade, the National Stock Exchange of India, and IREX. Derivatives can be bought and sold on almost any capital market market asset class such as equities, fixed income, commodities, foreign exchange, and every cryptocurrencies. Participants in a derivative market. There are four participants involved in derivative trading. They are as follows. First is a hedger. The main focus for hedger is a protection, often known as a risk-averse traders. Hedgers like to protect themselves from the possible price fluctuation in the future. Hedgers are active in the commodities market where the price fluctuations are rapid. Future and options trading can offer them the much needed price stability in such instances. Second is speculators. Speculators are risk takers who wish to earn good profit. They constantly monitor the markets, the news, and any other information that could affect their trading. As a result, speculators place an educated wager on the underlying asset's price. In simple terms, speculators seek to purchase an asset at a lower price in the short term while betting on bigger returns in the long run. Third is the arbitrageurs. Arbitrageurs take advantage of the price difference of the same asset across different exchanges. Arbitrageurs buy securities at a low cost in a one market and sell them at a higher price in a different market. Fourth is a margin traders. Brokers in the derivative market require a deposit or margin amount from investors. Margin amount is a minimum amount that investors have to deposit with the broker to trade in the derivative market. As a result, the trader can maintain a sizable outstanding position. Thank you.